The Forex market operates 24 hours a day, 5 days a week. Opportunities open and close in milliseconds, often long after you've gone to sleep. When you trade manually, you bring two distinct disadvantages to the market. First, your physical reaction time is capped by how fast your brain can process visual information and instruct your hand to click a mouse. Second, your decisions are vulnerable to fear and greed, which causes you to hesitate on optimal setups or hold on to losing positions. Relying on human reflexes and emotions in a market that never stops moving guarantees you will miss precise entry points and lose out on potential profits. To bypass human limitations, traders use a REST API. An application programming interface acts as a secure messenger between your custom software and the broker servers. Your code sends precise, automated instructions straight to the execution engine, completely bypassing a graphical user interface. By codifying your strategy, you stop reacting to market ticks manually and start engineering a proactive system that executes your rules with absolute discipline. Building that system starts with Python. Python is a programming language widely used in retail algorithmic trading because its simple syntax makes it highly effective for analyzing large data sets and building automated logic loops. Your Python code needs a way to communicate its decisions, and it does this using JSON. JSON stands for JavaScript Object Notation. It's a standardized, easy-to-read format that packages your trading commands into basic key-value pairs, like symbol, URUSD, and action, buy. To send that JSON data across the internet, your system uses HTTP requests. These are the standard web protocols your browser uses every day. Your bot will use a GET request to fetch market data and a POST request to submit your live orders. Mastering Python for logic, JSON for packaging, and HTTP for delivery provides the toolkit to translate trading ideas into executable market commands. Let's see how these tools execute a specific strategy. We'll set a rule to buy the euro against the US dollar when a fast 10-period exponential moving average crosses above a slow 30-period EMA. An EMA is simply a moving average calculation that places a greater weight on the most recent price data. This chart shows exactly how the bot gathers data. The script fires an HTTP GET request to the broker, pulling in the last 50 historical price candles for the euro-USD pair. With the data secured, the Python script calculates the 10 and 30 EMAs for each candle. It scans the resulting numbers to pinpoint the exact millisecond the 10-period value becomes greater than the 30-period value. The moment that crossover condition is met, the system instantly compiles a JSON payload, packaging the symbol, the trade size, and the buy command into a formatted text block. Finally, the script executes an HTTP POST request, firing that payload directly to the broker's server, where the trade is confirmed. This entire cycle of fetching, analyzing, and executing happens in fractions of a second. It operates without hesitation or physical delay, demonstrating the raw execution superiority of an automated machine. But a machine that operates in milliseconds can also lose money in milliseconds. If your bot encounters an error or a flaw in its logic, it lacks human intuition. It will execute bad trades relentlessly until your account is empty. You have to write specific safety nets directly into your code. The first rule is that every single order your system generates must include a hard-coded stop-loss parameter. This caps your maximum downside on any individual trade before it even reaches the broker. Next, you build a circuit breaker. A circuit breaker is a master control function designed to monitor the bot's overall performance. If it detects 3 consecutive losses, or if the daily drawdown exceeds 2%, the code automatically halts all new trading activity. You also have to account for external server issues. Brokers limit the number of API requests you can make per minute. If you hit that limit, or if the server goes down for maintenance, your code must be programmed to pause and retry gradually, rather than aggressively spamming the broker with failed requests. A successful automated strategy relies on its entry logic, but its long-term survival is determined entirely by the robustness of its failsafes and error handling. Once your script is written and fortified, you never connect it directly to a live account. You follow a strict 3-phase deployment protocol to test its viability safely. This diagram illustrates the crawl phase. Here, you validate the core logic by backtesting the script, running it against years of historical market data to see exactly how it would have performed in the past. If the historical results are positive, you move to the walk phase. You deploy the bot on a demo account that uses a live data feed. This tests how your code handles real-world server latency, fluctuating spreads, and live market ticks, without risking real capital. Finally, in the run phase, you connect to your live account but set the bot to execute the absolute minimum trade size allowed. The goal here is to verify that your order execution and risk management rules function perfectly with real money on the line. Following this methodical process mitigates catastrophic technical errors. It allows you to build the evidence and confidence required to let the machine navigate the markets autonomously